You see a YouTube ad promising convert $20,000 to Roth at just 12% federal tax. That sounds like a straightforward win. Then you live in California, and the real tax bill comes back at $4,200 instead of $2,400. That gap of $1,800 on a single $20,000 move does not show up in the spreadsheet your advisor sent you. It shows up in April when it is too late to undo anything. The 12% federal bracket conversion advice has been shared millions of times. For retirees in states like California, New York, or New Jersey, it is quietly wrong. Not a little wrong, significantly wrong. The IRS does not tax in isolation. Your state taxes, Medicare, and Social Security are all reacting to the same conversion at the same time. For many retirees, the effective marginal rate on a Roth conversion can reach 25% or higher. That is more than double the headline number they were sold on. We are going to walk through the real math on a $100,000 conversion. By the end of this video, you will see exactly how much of your money is silently leaking through 3 separate tax systems and what to do instead. If you have been thinking about converting, do not move yet. Hit subscribe so you do not miss what is coming next. This channel runs the numbers the way you actually need to see them. The problem is not that people misunderstand tax brackets. The problem is that a Roth conversion does not trigger one tax bill. It triggers 3. Here is how the chain works. You convert $10,000 from your IRA. That $10,000 shows up as ordinary income on your federal return first. At the 12% bracket, that is $1,200. Straightforward enough. But then that same $10,000 flows into your state return. If you live in California and your income is above $68,350, you are in the 9.3% state bracket. That adds another $930. You are already at $2,130 on a $10,000 conversion, and we have not touched Medicare or Social Security yet. Now add IRMAA. For 2026, if this conversion pushes your modified adjusted gross income above $109,000 as a single filer, your Medicare Part B premium jumps. The first IRMAA tier adds roughly $970 a year. That is not a one-time cost. That premium increase applies for the entire year following the conversion. On top of that, about $300 more comes from the Social Security Tax Torpedo. Because additional income pushes more of your benefits into the 85% taxable range once you cross the $34,000 provisional income threshold. Add it up, $1,200 federal, plus $930 state, plus roughly $1,000 in IRMAA, plus $300 from Social Security taxation. That is approximately $3,430 on a $10,000 conversion. The effective rate is 34%, not 12%, and this is not a rare situation. The Tax Foundation found that retirees earning between $75,000 and $100,000 in high-tax states already face a combined federal and state marginal rate of 28.3% before IRMAA and Social Security taxation even enter the picture. When you add those two factors, 30 to 34% is entirely realistic. This is not a math error on your part. It is the result of 3 separate tax systems that were never designed to work together. The federal code, state codes, and Medicare were each written at different times, and they all reach into the same pile of money simultaneously. You are not supposed to have figured this out on your own. The advice that says, convert at 12% often comes from people who only run the federal number. It sells well because 12% sounds low and manageable. But for someone living in a high-tax state, 12% is just the entrance fee. And there is actually another layer beneath this one. What happens when you have no outside cash to pay the tax, so you end up withholding from the IRA itself? That turns a conversion into a loan you are taking from your future self, repaid at 34%. So how do you protect yourself from this? You stop asking what federal bracket you are in, and you start asking a different question: what is your all-in marginal rate on every dollar you convert? That is the framework. It sounds simple, but most people have never run this calculation because no single tax form makes it easy. Here is how to do it. First, project your taxable income for the year, including pension, any part-time work, Social Security, and required minimum distributions if you are already taking them. Second, add the conversion amount on top. Third, calculate the total federal plus state plus any IRMAA-related premium increase plus the Social Security tax bump from crossing the provisional income thresholds. Fourth, compare that all-in rate to what you realistically expect to pay when you eventually withdraw the money, whether from an RMD at age 73 or a planned withdrawal in a lower income year. If your current all-in rate is higher than your projected future rate, the conversion costs you money. Here is a quick example. You are married, filing jointly, living in New York. You convert $20,000 in 2026. You are in the 22% federal bracket, so that is $4,400 in federal tax. New York State adds roughly 6.5% on income at that level, another $1,300. If the conversion pushes your modified adjusted gross income above $218,000, the joint IRMAA threshold for 2026, Medicare adds roughly $2,000 per year in Part B premiums across both spouses. All in, you are looking at about $7,700 on a $20,000 conversion. That is an effective rate of around 38%. Now ask yourself this: if you wait until age 73 and RMDs force that money out anyway, what rate would you face then? If you are in a lower income year, maybe 24% federal plus 6.5% state, with no IRMAA exposure. That is 30.5%. You would have converted at 38% to avoid paying 30.5% later. That is the wrong direction. I used to tell clients to convert at 12% federal and not worry about the rest. I was wrong. The first time I sat down with a client in New York and ran all 4 layers of the calculation, the number surprised both of us. I changed my approach after that conversation, and that experience is the whole reason this framework exists. For roughly 20% of retirees who live in high-tax states, the conversion math is not just neutral, it actively works against them. And most of them have no idea because the advice they received never went past the first number. This problem has been building for nearly 2 decades. When the 2008 financial crisis hit, millions of Americans who were close to retirement postponed by 2 or 3 years. Those extra working years meant extra contributions, extra growth, and IRA balances that swelled well beyond original projections. At the same time, IRMAA was introduced in 2007, and its thresholds have not been adjusted consistently with medical cost inflation. The result is that more retirees than ever are getting clipped by surcharges they did not expect, at account sizes they did not plan for. Now consider the timeline. A 65-year-old man today has a life expectancy of 84.3 years according to SSA actuarial tables. That is nearly 19 years of required minimum distributions ahead of him. If his IRA grows at 6% annually and he only withdraws 3%, the balance roughly doubles in 24 years. The RMD at age 73 might be $30,000. By age 88, that same account could be generating $60,000 or more in forced withdrawals each year, all of it taxed as ordinary income. That long timeline means the spending reluctance problem is not a minor inconvenience. Left unaddressed, it can compound into 6 figures of extra taxes over the course of retirement. And converting aggressively now, at today's high all-in rates, is not the fix. It is just trading one tax bill for another, with worse timing. Let's be honest about what the two paths actually look like over time. The first path is aggressive conversion. You push hard in early retirement to get ahead of future RMDs. You convert $100,000 per year for 3 years at an all-in rate of 28%. That is $84,000 in taxes paid immediately. Your IRA drops from $1,200,000 to roughly $900,000. Your future RMDs will be smaller, yes. But you spent $84,000 of capital that could have stayed invested. And that taxable savings account you drew down to pay the bills? Now it is thinner, and you have less flexibility in an emergency. The second path is more deliberate. You convert smaller amounts, around $30,000 per year, but only in years when your all-in rate stays at or below 18 to 20%. At the same time, you commit to spending at least 4% of your IRA each year, even if that feels uncomfortable. So a $1,200,000 IRA generates at least $48,000 in annual spending. Some of that money may get reinvested in a taxable account if you do not need it immediately. The goal is not to spend it on unnecessary things. The goal is to keep the IRA from ballooning unchecked. Run both paths forward 20 years for a couple who are both 65 today. The aggressive converter ends up with a portfolio of roughly $1,100,000 by age 85. The deliberate spender ends up with roughly $1,300,000. That is a $200,000 difference, driven entirely by the timing and rate at which taxes were paid. The second path also preserves optionality. If tax laws change, you can adjust. If a health event reduces income in a given year, you can convert more at a lower rate. If qualified charitable distributions become a better fit after age 70 and a half, you can pivot. The aggressive converter has already locked in the cost. But here is the question nobody asks until it is too late. What happens if a market crash hits right after you convert? Imagine you convert $50,000 in 2027 at an all-in rate of 25%. You write a check to the IRS for $12,500. The conversion is done. The money sits in the Roth. Then the following year, the market drops 30%. Your IRA, which was $600,000 after the conversion, falls to $420,000. The $50,000 you converted is now worth only $35,000 in the Roth account. You paid $12,500 in taxes on income that has since shrunk by $15,000. The conversion did not save you anything. It locked in a tax loss. This is not a made-up scenario. Major market declines of 30% or more have happened roughly once every 10 to 15 years throughout S&P 500 history going back to 1926. That is not a tail risk. That is a recurring feature of long-term investing that any retirement plan needs to account for. The retiree who was not prepared for this tends to respond the same way. They panic. They stop converting entirely. And in some cases, they start pulling money out of the Roth to cover living expenses, especially if their taxable accounts got hit too. If they are under age 59 and a half, that triggers penalties on top of the losses. The tax bill becomes permanent damage to an account they can never replace. The retiree who handled this better did a few things differently. They converted only in years when their all-in rate was at or below 20%. They kept a buffer in taxable accounts rather than liquidating everything to fund conversions. After the crash, they used tax loss harvesting in those taxable accounts to offset gains elsewhere. And they had a spending plan in place that let them reduce withdrawals during the downturn, so they did not have to touch the Roth at all. The difference was not intelligence or luck. It was having a framework that built in some room for things to go wrong. If you are still thinking a large conversion is the right move, there is one more strategy worth knowing about. It can often make conversions completely unnecessary. So what do you actually do? There are 3 levers, and most people are only using one of them. The first lever is to calculate your total marginal rate before you convert anything. That means pulling your state tax return, looking up the current IRMAA thresholds for your filing status, and using the IRS worksheets to figure out how much of your Social Security becomes taxable at different income levels. If your all-in rate comes out above 22%, the general guidance is to convert only enough to fill the lower brackets, not the next one up. The break-even point is your expected rate when RMDs begin. If you are converting now at a higher rate than you expect to face at age 73, you are paying in advance at a premium. The second lever is mapping your income for the next 10 years. Most people have what you could call low-income windows, typically the years between when they retire and when they start taking Social Security. Those years often have lower taxable income, and that is where partial conversions make the most sense. The key is staying under the IRMAA threshold. For 2026, the first IRMAA tier for a single filer starts at $109,000 in modified adjusted gross income. If your base income in a given year is $70,000, you have about $39,000 of headroom before the Medicare surcharge kicks in. You could convert $30,000 each year for 3 years and stay clear of IRMAA entirely. That is $90,000 moved to Roth at a manageable rate without triggering a premium increase. The third lever is Qualified Charitable Distributions, and this one is genuinely underused. If you are 70 and a half or older, you can direct money from your IRA straight to a qualifying charity up to $111,000 per person in 2026. That distribution counts towards your RMD for the year, and it never shows up as taxable income on your return. For a $1 million IRA with a $40,000 RMD, donating $40,000 directly to charity means you pay 0 federal income tax on that withdrawal. That $40,000 never triggers IRMAA. It never pushes more of your Social Security into the taxable range. You completely bypass the tax chain we talked about earlier. Now, the question I hear most often, what if you have no cash outside the IRA to pay the conversion tax? The honest answer is this. If you must convert and you have no outside cash, convert only enough to stay in the 10% or 12% bracket and use a small portion of the IRA to cover the tax. But understand what you are doing. You are withdrawing extra money to pay the tax on a conversion, which reduces your invested balance and your future growth. If that situation applies to you, it is often better not to convert at all. A smaller Roth done right is worth more than a large one done at the wrong rate with the wrong funding source. Let's talk about the other half of this problem, because understanding the math is one thing. Being able to act on it is another. After 40 years of saving, the idea of spending your IRA down does not feel like good financial planning. It feels like losing. Your brain has been wired to treat that balance as security, and every dollar leaving the account registers as a threat. Behavioral economists call this the endowment effect. You value what you already hold more than what you could gain by letting it go. It is not a character flaw. It is how human beings are wired when it comes to accumulated assets. You did everything right. You saved consistently. You delayed gratification. You built something real. The fear of running out in your 90s is completely rational, given how unpredictable medical costs and late life care can be. But that same rational fear is exactly what causes the IRA to keep growing, the RMDs to keep climbing, and the tax problem to compound year after year. The fix is not to try to spend more. That rarely works because it asks you to fight a deeply ingrained instinct. Instead, set a minimum spending floor. Commit to withdrawing at least 4% of your IRA balance each year. even if you do not need every dollar of it. If you feel uncomfortable, take the excess and reinvest it in a conservative taxable account. The money is not gone, it is just in a different pocket. But by moving it, you prevent the IRA from growing unchecked into a future tax burden. I have been there personally. When I was 63, I had $780,000 in a traditional IRA and could not bring myself to touch it. I kept saying I would spend more next year. I did not. It was not until I ran the RMD projection at age 73 and 80 and 85 that I actually changed my behavior. The numbers made it impossible to ignore. The first year of increased withdrawals felt wrong. By the third year, it felt like planning. Let's bring it home. Every Roth conversion decision has to start with your total marginal rate, not just federal. Federal plus state, plus any IRMAA premium increase, plus the Social Security tax impact. If that combined rate comes out above 22%, you are likely better off spending your IRA down strategically or using qualified charitable distributions instead. The 12% federal number that gets advertised is just one piece of a four-part equation. You do not need to convert everything. In fact, most people within 5 years of retirement should convert very little, if anything at all. The peace of mind that comes from avoiding a 30% tax bill today is worth more than a slightly smaller IRA balance 10 years from now. And if your circumstances change, tax laws change, or a low-income window opens up, you can always convert then at a better rate. The goal is not to eliminate Roth conversions entirely. The goal is to do them only when the math actually works in your favor. If this video helped you see the full picture on conversions, hit subscribe and drop a comment below. What is the most confusing piece of Roth conversion advice you have come across? I read every one.